The stock market can seem like a mysterious place, but don't worry, we're here to demystify it for you. It's simpler than you think. At its core, the stock market is a place where people come together to buy and sell ownership in companies. Think of the stock market as a giant shop where you can buy and sell pieces of companies. These pieces are called stocks. Stocks represent a share in the ownership of a company and constitute a claim on part of the company's assets and earnings. When you buy stock, you own a small part of that company. This means you have a stake in its success and can benefit from its growth. Why should you care about the stock market? Because it's a powerful way to grow your money over time. Investing in stocks can help you build wealth, because it's a powerful way to grow your money over time. When you invest in the stock market, you're giving your money a chance to work for you. When you invest in the stock market, you're giving your money a chance to work for you. Over the long term, the stock market has generally gone up. Over the long term, the stock market has generally gone up. This means that your investments can grow in value, helping you achieve your financial goals. This means that your investments can grow in value. However, it's important to understand that investing in the stock market comes with risks. Of course, there are risks involved. The stock market can be unpredictable, and prices can fluctuate widely in the short term. The stock market can be unpredictable. It can go up and down in the short term, which can be unsettling for new investors. It can go up and down in the short term. That's why it's important to invest for the long haul and not panic if the market takes a dip. That's why it's important to invest for the long haul and not panic if the market takes a dip. Investing in the stock market is a marathon, not a sprint. Investing in the stock market is a marathon, not a sprint. Patience and a long-term perspective are key to successful investing. Remember, this guide will give you the basics of the stock market. You'll learn how it works, how to get started, and how to make smart investment choices. You'll learn how it works, how to get started, and how to make smart investment choices. With the right knowledge and approach, you can navigate the stock market with confidence, and how to make smart investment choices. So let's dive in and explore the exciting world of the stock market together. Let's break down how the stock market works. The stock market is a complex system, but at its core, it's a place where buyers and sellers come together to trade shares of publicly listed companies. These trades happen in real time, and the prices of stocks fluctuate based on various factors, including company performance, economic indicators, and investor sentiment. Companies need money to grow. They might need funds to develop new products, expand into new markets, or hire more employees. To raise this money, companies can issue stocks, which are essentially small pieces of ownership in the company. They get this money from investors like you. When you invest in a company's stock, you're providing the capital they need to achieve their growth objectives. In return, you become a part owner of the company, with a claim on its future profits. When you buy stock in a company, you're giving them money. This transaction is facilitated through stock exchanges, which act as intermediaries between buyers and sellers. The process is seamless and can be done with just a few clicks on a trading platform. In return, you get a share of their ownership. This ownership entitles you to a portion of the company's profits, which may be paid out as dividends. Additionally, if the company performs well, the value of your shares may increase, allowing you to sell them at a higher price. The price of a stock goes up and down based on supply and demand. If a company is doing well and investors believe it will continue to grow, more people will want to buy its stock, driving up the price. Conversely, if a company is struggling, more people may want to sell, causing the price to drop. If more people want to buy a stock, the price goes up. This is often driven by positive news, strong earnings reports, or favorable economic conditions. Investor sentiment plays a significant role in driving demand for stocks. If more people want to sell it, the price goes down. Negative news, poor earnings reports, or economic downturns can lead to increased selling pressure. This dynamic nature of the stock market makes it both exciting and challenging for investors. This is how the market determines the value of a company. The collective actions of millions of investors buying and selling shares create a constantly changing valuation for each company. This valuation reflects the market's perception of the company's future prospects. There are two main types of markets, primary and secondary. The primary market is where new stocks are issued and sold for the first time, while the secondary market is where existing stocks are traded among investors. The primary market is where companies sell new stocks to raise money for the first time. This is often done through an initial public offering or IPO, where a company offers its shares to the public for the first time. This is like an initial public offering, or IPO. During an IPO, a company works with investment banks to determine the price and number of shares to be sold. This process helps the company raise the capital it needs to grow. The secondary market is where investors buy and sell those stocks from each other. This market provides liquidity, allowing investors to easily buy and sell shares without directly affecting the company's capital. Think of it like buying and selling a house. When you buy a house from the original owner, that's similar to the primary market. The transaction is direct and involves the original seller. The first time a house is sold, that's like the primary market. The original owner sells the house to a new buyer, and the transaction is recorded as a primary sale. After that, people buy and sell the house from each other in the secondary market. This is similar to how stocks are traded among investors after the initial sale. The secondary market ensures that there is always a buyer and seller for every stock, maintaining the market's liquidity and efficiency. Now let's talk about some key places in the stock market. You've probably heard of the New York Stock Exchange, or NYSE. This is a famous stock exchange where stocks are bought and sold. Another important place is your brokerage account. This is like your bank account for investing. You need a brokerage account to buy and sell stocks. Finally, you'll hear about market indexes. These are groups of stocks that represent a particular part of the market. For example, the S&P 500 is an index of 500 large companies in the United States. These indexes can give you an idea of how the overall market is doing. Just like you need to know where the bank and the store are in your town, you need to know the important places in the stock market. Ready to start investing? Great. The first step is to set your financial goals. What are you saving for? Retirement? A down payment on a house? Knowing your goals will help you determine how much to invest and for how long. Next, you need to open a brokerage account. There are many different brokerage firms out there, so it's important to compare fees and services before you choose one. Once you have a brokerage account, you can start investing. But don't just jump in blindly. It's essential to do your research and understand what you're investing in. Remember, investing is a marathon, not a sprint. Take your time, learn the ropes, and start small. Section 5. Choosing your investments. Now comes the fun part, choosing your investments. You can invest in individual stocks, which means buying shares of specific companies. Or you can invest in funds, which are baskets of stocks that track a particular index or sector. Investing in individual stocks can be exciting, but it's also riskier. You need to do your research and understand the company's financials before you invest. Investing in funds is a good way to diversify your portfolio and reduce risk. There are many different types of funds, such as mutual funds and exchange-traded funds, or ETFs. Mutual funds are professionally managed, while ETFs trade on an exchange like stocks. The best type of investment for you will depend on your individual goals, risk tolerance, and time horizon. Section 6. Strategies for long-term success. Now that you know the basics of investing, let's talk about some strategies for long-term success. These strategies are designed to help you navigate the ups and downs of the market and come out ahead in the long run. The most important thing is to have a long-term perspective. This means thinking in terms of years or even decades rather than days or months. The stock market goes up and down in the short term, but over the long term it has always trended upwards. Historical data shows that despite periods of volatility, the overall trajectory is positive. Another important strategy is to diversify your portfolio. Diversification means spreading your investments across different types of assets to reduce risk. Don't put all your eggs in one basket. By investing in a variety of stocks, bonds, and other assets, you can protect yourself against the poor performance of any single investment. Invest in a variety of stocks and funds across different sectors and asset classes. This way, if one sector underperforms, others may perform well, balancing out your overall returns. This will help to reduce your risk if one particular investment doesn't perform well. Finally, don't panic sell. Emotional decisions can lead to significant losses. It's normal for the stock market to fluctuate. Short-term volatility is part of the investment landscape, and it's important to stay calm during these periods. If you've invested in solid companies and funds, your investments will recover over time. Trust in the strength and resilience of well-established businesses. Remember, investing is a marathon, not a sprint. It's about steady progress and endurance, not quick wins. Be patient, stay the course, and you will be rewarded in the long run. Consistency and discipline are key to achieving your financial goals. Section 7. Mistakes to avoid. Even experienced investors make mistakes, but as a beginner, there are some common pitfalls you can avoid. One of the biggest mistakes is investing based on emotions. Don't let fear or greed dictate your investment decisions. Another mistake is not doing your research. Before you invest in any stock or fund, take the time to understand what you're investing in. Look at the company's financials, read analyst reports, and understand the risks involved. Finally, don't chase returns. Don't just invest in the latest hot stock. Instead, focus on finding solid companies with strong fundamentals that are undervalued by the market. Investing is not a get-rich-quick scheme. It's about making smart, informed decisions that will help you reach your financial goals over time. Section 8. Resources for smart investing. You don't have to navigate the stock market alone. There are many resources available to help you make informed investment decisions. Your brokerage firm likely has a wealth of educational materials, including articles, videos, and webinars. There are also many reputable financial websites and publications that provide investment research and analysis. Some popular options include Morningstar, Yahoo Finance, and the Wall Street Journal. If you're looking for personalized advice, you may want to consider working with a financial advisor. A financial advisor can help you create a financial plan, choose investments, and manage your portfolio. Remember, knowledge is power. The more you learn about investing, the better equipped you'll be to make smart decisions. Section 9. Your journey to financial growth. Congratulations! You've taken the first steps on your journey to financial growth. Investing in the stock market can be a rewarding experience, both financially and personally. As you continue on your investing journey, remember to stay informed, stay disciplined, and stay focused on your long-term goals. Don't get discouraged by short-term fluctuations in the market. Remember, time is your greatest ally when it comes to investing. The stock market can seem intimidating at first, but it's a powerful tool that can help you achieve your financial dreams. With a little knowledge and a lot of patience, you can become a successful investor. So, what are you waiting for? Start investing in your future today.